Reliability is the word that comes to mind. It's exactly the issue that so many builders are facing. They walk into a situation, maybe they've got a local real estate agent who brings them an opportunity, and they want to make an offer on this land. Well, reliability steps in right off the bat. If you're not certain whether your capital is there for you, can you really make a confident offer? And then you get maybe you funded a loan at this point, and maybe the lender gave you fantastic terms that you feel really great about, but at the very next minute you're concerned about, gosh, are they going to make my draws? Is it going to take them a month or 3 months to process my draws? And so again, reliability becomes a major factor. And the other end of to add to that, I should say, let's say you've got a lender that uses warehouse financing. And that warehouse financing is provided by a bank that's controlled by a regulator. As of course they all are. And that regulator realizes that bank is above their real estate, the regulatory limit, and they get their warehouse lines cut. So the lender that you worked with may not have any financial struggle whatsoever, but if their warehouse line gets cut, your draws got cut. So there's so many areas in which reliability becomes paramount and truly a key to a necessary step to survive, let alone thrive. The word that comes to mind is consistency. If you're a production builder, you've got projects constantly in your pipeline, and the ability to consistently, and I'll swing back to reliability again, but consistently and reliably depend on your capital partners to be there as you continue to grow and scale your business. We had a situation, it's probably been a year ago now, but I'm not very good at keeping track of time sometimes. So, but we had a builder who had successfully completed and 100% exited 89 straight projects. Number 90 comes along. It's a $24 million project, and the bank says, yes, no problem. And they get to be just a few weeks before closing, and the bank's like, we can't do it. And these guys had already dropped this number, I don't remember, but we're going to say $2 million in feasibility and engineering and all the things that a builder has to invest in up front to get to make sure they've got a project that's going to work for them and pencil. And they had no choice but to move outside of their banking relationship. And we stepped in and funded that loan. And we've since funded 3 more loans with these guys, but they had never used a private lender. They had only used that local community bank, and they had a great relationship with them. But when that bank couldn't perform, they had to scramble. And being in a situation in which you have to scramble is not good for one's stress levels. Cash to close is becoming a bigger and bigger and bigger issue over the last 6 months to a year. And it's becoming a bigger issue because of banks are increasing deposit requirements. They're increasing liquidity requirements, and they're decreasing loan to cost, loan to value ratios at the exact same time. So what that means is a builder has to come in with more cash to close, and more cash to close is not an easy thing to overcome, because most builders manage their business really a little bit more based on cash flow and what do I have available? Where can I invest it? Where do I need to deploy it? Where do I need to place it? And anything that locks up or reduces that availability of cash has a very direct negative impact on their ability to scale, because instead of doing 2, 4, or 10 projects, depending on the size of your operation, you're now only going to be able to do 1, 2, or 3. Because if you've got to double the amount of cash that you drop into a single project, or your deposit requirements or your liquidity requirements, or any of these things are increased by your current financing, that's that much less cash you've got to deploy. And therefore that's that many fewer projects that you can step into. And, talk about being on a rat race, right? Where you can never get ahead because the cash requirements just keep going up and up and up. And you can therefore never scale your business because you can't go from doing let's just say 3 projects at a time to doing 4 or 5 because of that cash to close. And it really is becoming, I think, the most important issue for a lot of builders out there that are trying to scale, and maybe they've had a great experience and they've got a reliable lender and they've found someone who has performed for them historically. But again, as those cash to close constraints get tighter and tighter and tighter, meaning that they've got to bring in more cash to close, that's going to reduce their ability to scale. Unfortunately, it doesn't just start post-close. One of the biggest fears that our industry struggles with is this bait and switch concept, where maybe a less sophisticated lender will put together a term sheet that they can't actually execute on. And you get to the closing table and the terms are dramatically different, but you have no choice at that point, right? It's too late for you to pivot. So unfortunately, it doesn't even just start after the close, but after the close, the fear becomes, again, draws. And I can't tell you how many stories and how many borrowers come to us after a really bad experience with a lender. And if you can't make your draws, then you've got to come cash out of pocket to pay your subcontractors. If you've planned your cash flow and you've deployed your cash so that you can maximize the number of homes you're building, because we all know we have a shortage in housing today. And so it's the right thing to do from a moral standpoint, let alone from a business growth standpoint, to have your cash deployed, and steps right back into the cash to close issue we just discussed. But if you've got your cash deployed in order to build as many homes as your market will absorb, then you get a situation where a lender can't or won't, or there's such delays with your draws that you run the risk of subcontractors walking off the job site. And it's not quite as bad from a labor market standpoint today as it's been over the last 5 years. But that subcontractor, in many cases, can literally walk across the street, will have a job in 15 minutes, and you may not get them back. And talk about a stressor, a stress factor is an inability to, I don't know, let's make up an example, but an inability to get your finish plumbing done. You're not going to sell a house until the plumbing's done. And the carrying cost of that loan can be absolutely crushing, let alone the risk to your subcontractor base. The thing that comes to mind immediately is hope springs eternal. And I think with a lot of builders out there, they walk into a situation hoping that everything will work out, hoping that their capital is reliable, hoping that their subcontractors, their suppliers, all those things are going to be reliable. And unfortunately, hope is not a strategy, not to make this all about cliches, but if you can walk in with confidence and clarity, that's the difference between a builder who is able to scale and a builder who is stuck in this cycle of hope. And the risk and the stress that comes with building a business around hope really draws into question whether it's worth it. So if a builder can really focus on consistency, reliability, and I don't know what the right word is, but the right execution with a partner they can trust who is going to be there with them through thick or thin, and that thought raises another point. A lot of lenders come into ground up construction lending who have a fix and flip background, and we have a fix and flip background as well. Now we moved on from fix and flip, many years ago. And there are a lot of lenders today that think that ground up lending is almost the same as fix and flip. And they roll into ground up, not realizing how incredibly different it is. Everything is different. It seems so simple to think, well, I do draws already. How hard could it be if you're a fix and flip lender? But you might do 1 or 2 draws. You're not doing a draw every week. We do 400 draws a month right now. Which reminds me, by the way, whoever gave you the data at 2.1 billion, we're now at 3.1 billion. So we've funded another $1 billion since that data you were provided. So I'm pretty proud of that. But the point again comes back to reliability and consistency are so necessary and critical to scale. And the difference is going to be a lender who really does understand ground up construction, not necessarily a lender who does 80-90% of their business in fix and flip. And I'm not suggesting they can't get there. They can do the things we've done of investing millions of dollars in technology and systems and processes and bringing in true experts with 20, 30 plus years experience in the space. And we really understand builders. Our president was a former builder. He's been in finance, not just finance, but ground up construction finance for 30 years. So we actually really understand the business at a different level than most people in our space. And so one of the keys, again, is finding a lender that really understands ground up, as opposed to finding a lender that either does everything and has a little segment of their business doing ground up, which would imply that they're not as committed to it or not as knowledgeable, or a lender that focuses on a different segment of the business and is adding ground up. They might provide great pricing today in order to buy market share. But if you don't get reliability and consistency and performance, you don't even know the real cost. And the real cost will be, unfortunately, a hard-learned lesson down the road. Well, we say all the time, go, do it, right? Try it out, because we know you'll be back. And speed of execution is always important, right? The ability to make decisions quickly is truly a value add to every business. And it's a necessary part of being a CEO and running a company. At the same time, haphazardly or foolhardily racing into a bad situation, that never pays in the end. And so speed is important, and it's certainly one of the value propositions that all private lenders offer over bank facilities. But that's not really as important as, again, reliability and consistency and performance. Speed is good. Again, don't get me wrong. Speed is a good thing. But a lender who doesn't have a good draw system set up for a builder that's doing a draw a week or a draw a month and hundreds of them a week or hundreds of them a month, you're going to find yourself in a situation where your draws are not getting processed. And if you get in that situation, and if you're pushing from a speed to execute standpoint, that would imply you're likely pushing from a cash flow standpoint as well, a cash deployment standpoint. And you might just, in fact, find yourself in the exact situation I described earlier, where you can't pay your subcontractors, and that can result in bankruptcy for a builder. So speed is absolutely important. It's one of the core advantages that private lenders offer over most bank situations. But prudent speed and reliable speed and practiced speed, we say all the time when we're addressing a situation or a challenge that we've seen this movie before. Right. So we know how it's going to play out. And so we know how to address situations prudently and quickly, but that doesn't mean haphazardly. And I think that's the real difference right there. It's been many years since we focused on fix and flip, but we got our start in the great financial crisis purposefully. We recognized a need and an opportunity to help, and we focused on foreclosure construction purchases. And in that space, you've got 20 minutes to make a decision when you know that a property is going to go to auction, and you've got to do all your underwriting. And so we cut our teeth. And granted, this is 15 years ago or whatever the math would be. But we cut our teeth in that speed of execution. So we learned how to do really good underwriting and all the things that we needed to do to feel safe in our lending, and also, frankly, to protect our borrowers from circumstances. Because back in the day, we've had many cases where somebody almost accidentally bought a second. And our work and our diligence to be able to quickly ferret out those sorts of challenges, prove to save our borrowers from many situations. But fast forward to today, we've not forgotten that speed of execution. We've not forgotten what the things that really need to be focused on that are the most important things. And so, unfortunately, a specific example doesn't come to mind, but the kind of thing that would be a situation in which someone raced to close because they've got to get this deal closed would be they find out after the fact that it's Dutch interest. Well, that can be crushing for a builder loan because Dutch interest, while being fine, Dutch interest, just for those who maybe don't know that term, Dutch interest means you're paying interest on the entire balance, whether drawn or not. Dutch interest was very common in the fix and flip world, and that made sense because in the fix and flip world, you were doing, let's make up numbers. Let's say 80% of the note amount was deployed at the initial advance for the purchase of the home. And then there's 20% of the note amount that was held back for construction. So if you're paying Dutch interest, you're paying interest on the entire balance, but 80% of that balance is deployed. So it's really only that extra 20% that you're paying interest on that you don't have yet. That's not good, but it's not crushing. It's not project destroying. Now you do a ground up construction loan, and let's say you deploy 20% at the time of closing and 80% is held back for construction. Now that Dutch interest can absolutely, it's not just can, it will absolutely crush your project and your profitability. So racing into a situation without understanding your lender, without understanding the terms, can be incredibly dangerous. We're in this for the long term. We're in this because we thoroughly believe in the thesis that we've got a shortage of housing in America. And the affordability challenges that we're all hearing about and witnessing and in some cases personally struggling with are a perfect example of that. So we're here to build more houses and to do our part in helping to build more houses. By being in it for the long term, it really changes your decision making about how you run your business. We're not in it to let's make as much money as fast as we can. We're not in the transactional business. We don't focus as much on short-term buying market share so then we can raise prices later after we've won a builder. We're focused on building more houses because we're focused on improving our community and improving home ownership. We really believe in the studies that have been done that show a direct correlation between the percentage of home ownership and crime, and not just crime, but violent crime. So we also have 20-something kids who are going to struggle to buy homes without help from mom and dad. And that's not the way it should be, and that's not the way it was. I bought my first home at I don't even remember, 23, 24, 25, something like that. And I worked hard and I saved my money and I really focused on the ability to buy a home because it was important to me. I grew up on a farm in Indiana, and the living in an apartment in the small space of an apartment wasn't for me. And so even though the house I bought wasn't much bigger than the apartment I lived in, having a little bit more space was important to me. And seeing the average age of a new home buyer, I don't even know what it is. Like, I think the last data I heard was 43, but don't hold me to that. But seeing people who are not buying a home for 10 and 20 years longer than my generation, or at least me personally, is really concerning because I think home ownership is truly the number one most important element toward, I'll use the word wealth creation, and different people have different definitions of what wealth means. But when you own your home and you make that mortgage payment every month, and I'm not suggesting that it's not hard sometimes to make that mortgage payment, but when you make that mortgage payment every month, a piece of that mortgage payment is going into equity. And it's like a forced savings plan. And when times are tough, if you keep making that mortgage payment, you're building equity and you're putting away a little bit of money every month that someday down the road, you're going to be rewarded for that diligence and that struggle during those times. And so again, I believe the biggest difference between, I hate to use the word wealth, but between wealth and struggling to build wealth is whether you're a homeowner or not. And I really am concerned about the path that we're heading down in terms of home ownership and affordability in our country. And I in my heart and in my gut and in my soul, I believe in this thesis that we have to build more houses. There's so many ways to address that. Again, reliability and consistency. I know I've touched on those topics over and over and over. And your opening question mentioned reliability. You've got to have a lender that understands your business. You've got to have a lender that's there for the long term. You've got to have a lender that specializes in ground up construction lending. Because if you don't have those things, you're not going to be able to scale because I've said for many years that all forms of investing has a certain number of big rocks that can trip people up. But one of the hard things about ground up construction lending is there's a million little things, a million little rocks that you can stumble on. And we believe that the only way you can learn those million little things is by having stubbed your toes over and over and over. And so repeat customer business is really important to us. Last time we did a true study and validated the data, we had 95.3% repeat customer business, meaning that our customers were coming back to us over and over and over. And that's a really important part of our business because it allows us to be more efficient and more effective for the builders we do serve. It also allows us to be more reliable in the sense that we don't have to do as much work with a repeat builder as we do with a brand new builder. And that allows us to pass the savings on to the builders that we choose to work with and the business that we choose to do. The other side of that question, though, is why it's so important to have a relationship-based lender is a lot of builders right now are struggling with their 2022 vintages still. They bought land at the top of the market where prices were really high. It was really competitive. We were coming out of COVID, and there are a lot of challenging transactions. And as every experienced builder knows, the most important thing from the physical property standpoint is how much you're into your land for. Because if you're into the land too high, you're stuck in a situation where you've got to build a bigger house than maybe the market will bear. If you've got to build a bigger house than the market will bear, your cost of construction is going to be higher, and therefore your sale price is going to have to be higher. Therefore, your carrying time is going to be longer, and it can absolutely not just crush your profits, but you can end up in a situation where you're upside down very quickly. And so the land purchase is so important. The reason I bring that up in this context is we have builders, because again, 95.3% of our business is repeat customer. Most of our builders we've worked with for years and years and years. And so we're struggling through those 2022 vintages right alongside them, right? We're not looking at it as a transaction that is at risk of failing. We're looking at a builder relationship and saying, how can we make sure this builder doesn't fail? How can we make sure this relationship doesn't fail? How can we be there to support this builder through this tough transaction? How can we help them exit that as close to successfully as possible so that they can continue moving forward and our relationship can continue moving forward? It's such a different mindset. And there are a lot of people in our space that come from the non-performing loan segment where they don't understand the power of repeat customers. And if you come from the NPL segment, every transaction is a unicorn. Every single borrower is a unicorn. You've got one house for a consumer that you bought at an auction or whatever the circumstances were. You financed it or however they got it. But you don't look at that person as a repeat customer. And therefore, your goal is, how can I maximize the amount of revenue I generate on a per borrower basis? Because if I've got a borrower that has any positive cash flow, I've got to maximize it, because I know I've got all these borrowers over here that are going to lose all this money. And so it's a completely different mindset for how you treat your customers. We don't treat a customer as a single transaction customer. We treat a customer as a long-term business relationship. And we recognize that not every transaction within a long-term business is going to be Pollyanna and perfect. And so we're trying to help builders not only maximize their cash flow, but we're trying to help them minimize the number of bad transactions. At the same time, we're trying to help them minimize the pain or loss associated with a bad transaction, so they can get back to doing more profitable transactions. We're right there in it with you, I think is the most important message. Again, this is a long-term play. I owned a software company. I made a little bit of money in my 20s and maybe early 30s, and eventually hired a wealth manager, blue chip all the way. I was young enough that I knew I didn't want to retire. I knew I'd go back to work. And so when I hired this gentleman who has still to this day a great career and is doing great work, but I said to him, I was 32 at the time. I remember that now. I was 32 years old. I was like, I will go back to work. I know I'm not working now. I'm taking some time off. I figure out what I want to do next. I will go back to work. So I'm going to focus on building a revenue stream and building a business that makes money. My only ask for you is just don't lose it. That's it. Just don't lose it. Like, that's the one thing I need you to do. And less than 6 months later, he had the great displeasure of calling me to admit that we had lost $1.5 million that day, as you said earlier. And it was crushing for me, because as a 20-something building a software company, every dime I made was rolled into building that company. I was living paycheck to paycheck, because every single penny I could spare, I was reinvesting into that business. And I never made $1.5 million in a year. I'm not sure I made $1.5 million in 10 years combined. I'd have to go back and look at it. But to lose that amount of money in a single day in an asset class that I didn't really understand was the absolute turning point in why I started this company, because I was seeking a capital preservation vehicle. And it started out, honestly, as a capital preservation vehicle for myself. But we so quickly recognized the need in the marketplace, and the need for reliability, and the need for someone who wasn't just solely focused on profitability, but was focused on a bigger, longer term strategic direction. And for us at that time, that strategic direction was capital preservation. When you're focused on capital preservation, you make long-term decisions, not short-term decisions. And then over time, as the housing market changed and this affordability crisis became as strong as it is today, our mission is still capital preservation. And that capital preservation applies not just to me, but our investors, but it also extends to our builders. We're helping people build wealth in their business, and we're helping them do that by building something that our marketplace needs, which is more homes. So then the mission, while still focused on capital preservation, evolved, I guess, from just capital preservation into, we need to do something about affordability. So again, we're in this for the long haul. I hope to be running this in 20, 30 years, God willing. But that changes everything about the way we make the way we run our business. We're not in the transaction business. We're not in the quarter by quarter business. We're in the multi-year, multi-decade business. And long-term decisions and that focus on long-term decision making completely changes the way you behave, but also the way you treat your customers and the way you're there for your customers. So circling back to the opening point, we're there with you, right? We're there with you. We want to help you grow. We want to help you build your business. We want to help you help our country by building more houses.